All right, guys. Welcome to our webinar today with Danny Riley of MrTopStep. It's an honor to have him here again at a Futures I/O webinar. He's going to talk today about the SP 500 SPOOs and no-nonsense straight talk. So let's get started, Danny.
Okay, thank you very much. I appreciate coming in. You guys, I want to start out by saying something that a couple of things that can you guys hear me? Okay,
yep.
great. Okay. Look, I think there's got to be a lot of straight talk when it comes to trading. And at the end of the day, through my experience of being on the trading floor, 38 years, all real live stuff, all big order entry, $5.3 million hit in the flash crash. There is no other MrTopStep. Not at the end of the day, not now, not ever. And I'm going to explain all this, and as we go forward, my whole mission in this is not to sell anything. It's not to promote anything. It's to talk straight about what's going on in these markets. My name is Danny Riley. I'm the owner of MrTopStep.com. My company provides financial news and trading education. I always say that there's no dress rehearsals when it comes to trading. I don't think there is. And I think you guys will agree with me. And I always say one other thing. I don't pretend to be smarter than you. I came from the trading floor. I didn't go to college. I went directly from high school down to the trading floor, and that's where I got my education. I'm not going to tell you where to clear your account. I'm not going to ask you where you clear your account. I'm not going to tell you how to trade your account or what to trade or even how to manage your risk, because at the end of the day, people can do what they want. They can be trained. They can be taught. But when it goes to live trading, people do different things, and not necessarily does everything work out as planned. I went from the grain room at the Board of Trade as a runner, to the bond room, over to the CME, where I built the world's largest S&P desk, the largest S&P operation in terms of volume, according to the CME statistics provided by the CME. It didn't matter to me if it was a one-lot order that was going into the pit or it was a 500-lot order. It was somebody's money. We did business, the desk did business for the big banks. UBS, I did all the program trading business, Bankers Trust, B of A, AIG, Goldman, BMO, SocGen, Merrill Lynch, Soros, More Capital, GLG, Citadel, Nomura, Adia. We did so much business on the trading floor, it was insane. And as we move forward, there's going to be a reason that I'm talking about this, because it's all going to come into one siphon, and it's about trying to keep and maintain your money. You know, trading has a way of taking small money out of small investors' hands, and I think that with a certain amount of tooling, a certain amount of work, you can be good at what you do in trading, and you can limit your risk. What I used to do on the trading floor is large customers used to depend on me for something that I call trading flow. Trading flow encompassed everything, from everything about knowing from the guy in the pit that had orders in his deck, buy stops above the market, sell stops below the market, premium levels, fair value, everything. In the 87 crash, listen only. In the 87 crash, I was doing business for everybody. We were watching what was going on when Tudor was circling the S&P pit, selling through different orders. We knew exactly what was going on. I was handling one of the largest S&P accounts in the world. It was King Fahd's business through a company called Capcom. We were doing 2,000 lots, 4,000 lots. It was the biggest stuff going on. Now, I'm familiar with big order flow. I know how big order flow affects the markets. I follow this in-depthly on the trading floor, and I follow it in-depthly on my trading screens that I look at every day. I think volume talks, and a lot of people will not agree, but, you know, at the end of the day, I think when you can learn to read your charts correctly, whether they be volume-based or whatever type of charts, and you can grab a feeling for that. You know, after days and days of looking at the same prices and the same price action and the market's going up and down, it's not just going to be your charts. It's going to come from your gut. And you have to maintain some type of feeling for these markets because you know what? You can't live, you just can't hold on to this for very long. You can't fall in love with your positions. You got to buy, you got to sell, and you got to get out of the way. Now, I worked for the Pitbull for 27 years. He's one of the best traders in the world. And I'll tell you one thing that I learned, and I wish I had learned a lot earlier in life, and I've learned it very, very much so over the last 10 years, that if you want to be successful, you want to be a good trader, you got to do the work. There's no other way around it, and that's the way it goes. There is no half-ass getting in here and getting out and thinking that you can just beat these markets by pure luck. There's no luck anymore, and there's no spread like there used to be in the trading pits where a local could get the edge on something and possibly somebody would sell something else and you could get in and get out like that. It doesn't work like that. So with this in mind, I want to say one last thing about this. I think that it's really, really important, and I'm going to say this because I'm a person that likes to keep things simple, stupid. Recently, I went from 6 screens to 10 screens. And I'm going to tell you, I'm a firm believer in not changing things that work. If they work, don't fix it. Don't even attempt to fix it. Over a couple, 2 or 3 weeks, everything that I looked at got thrown off by moving my screens around by adding screens. I don't believe in adding indicators. I think that what you've got to do, you've got to learn to read these markets. You got to know that they're volatile. You got to use whatever risk management you think is important to use and make sure you use it. Because you know what? These markets take a little money away very quickly. So anyways, look, I want to go back a little bit in time here. And I'm going to go back to July of 2015. And around that time, the Pitbull came to me. His name's Marty Schwartz. He's been my friend and an unbelievable trader, one of the best in the world. And Marty told me that, and told everybody in our forum that to beware of the final week of July, that something really big could happen and volatility could pick up. No one would have ever known what was going on. I mean, we all knew that China was falling apart. We all knew that things were moving around big, but nobody ever knew how much the markets were going to fall, how quickly they were going to fall. Now, I say that I've been part of every stock market event since 1985, and I've been in the Middle East. Was there in Gulf War I and Gulf War II. I was in Thailand during the Asian currency crisis. I've been part of every major market move ever since. And one of the things that I think has happened here is that the algorithmic and program trading has taken over these markets. And I think what happens is in the old days, when I'm just going to refer to this as the old days because I think that's how we saw it back on the floor, is open outcry order entry. And you could see the orders going in. You could see the trading flow. You could see how it would affect. If I was doing a sell program in the S&P, I would be bidding for futures, and when I bought those futures, they would let go of the cash. And I could see how those programs reacted in the marketplace. I could feel it. I could see it. I saw a trading rule that I wrote around it, that after 3 or 4 sell programs, the bids would come in and start to pile up into the big S&P pit. And once those bids started to pile up like that, it would cause a short covering rally. We saw things like that. There's there's things in here within the market that you can work with, and I believe that it's got a lot to do with pattern recognition and looking at your charts, staring at your charts. That's what I used to do in the pit. I used to stare into the pit. I used to look up at the boards. Now, as this stuff unwound going into the end of the year, and along came August 24th, I'm going to tell you something. I was the first one to coin August 24th as a flash crash. I put that out on my Twitter, and about 45 minutes later, everybody was saying it. I was there in the flash crash in 2010. Our desk took a $5.3 million hit in 20 minutes. So no one can tell me that I wasn't part of the deal. I was down there at the desk. I remember that day. I remember looking down the desk. We had a trading rule on the desk that we didn't want to take big orders during big periods like that. I looked down 5 guys deep. I asked everybody if everybody was okay, if there was any problems. And I remember the kid at the end of the desk raising his hand, and he had an order in his hand. And I got up out of my desk, and I remember shaking my head. I knew this wasn't going to be good. And he was sitting at the end of the desk, and he's got a 3,000-lot put order that some hedge fund tried to unwind through our desk. And when the futures rallied, it left him short. It left him long the puts. He unwound the spread. Once he unwound the spread, it left him short the puts, or no, long puts, with the futures rallying the way they did. He lost $57 or $60 million in 20 minutes. When I walked down to the end of the desk, I got the order. I looked at it. I knew right away. He covered these puts at 3,500, 35 even. He was short him like $2 or $3, 3,500 points. And by the time that the fill was even back at the desk and it was figured out, everybody had lost their money. And the clerk at the end of the desk said to me, "Listen, you got a problem on this." And I said, "I don't have a problem on it." And the guy got on the phone. And he explained to me. He said, "Danny, if you can't go in the pit and you can't get those 35 evens brought down to 25 even, you're going to be stuck with over $5.5 million in losses." So I know about fear and I know about greed, and I've seen it my whole life. I saw it from the day I walked on the Board of Trade floor when I was 18. I saw it all the way up to the point that I left the CME floor a year and a half ago. Now, is this stuff built up going into the end of the year? I think that China kind of piled in, but it wasn't just China. At the end of the day, I think what's going on here is the free money trade is over. The United States is backing out of zero borrowing costs. The free money that helped support these markets, that gave everybody a free ride for the last 6-7 years, is gone. And it's still kind of out there. But at the end of the day, the fear gauge got extreme a month ago. As we went into the end of January, as you recall, there was a big rally at the end of January, and then we had a big drop in the beginning of February, and now it's kind of leveled off again. But at the end of the day, I don't think you guys can tell me. I think this is far from over. I don't think we're anywhere near from concluding what's going on with the Federal Reserve in the United States, what's going on with the Europeans lowering their rates, what's going on with the yen carry trade, what's going on with just, you name it. How about the British pound yesterday? Down 20% in one day. This stuff isn't going to stop. So here, what I've done, and I'm just going to be honest with you guys. I'm not the most studied. I don't read a lot of books. I sit here, I look at the markets all day long. I get up every morning. I kind of keep myself abreast of what went on overnight, any kind of pertinent news, what's going on, and also I look at certain news stories. And I think some of the news stories that have come out have been rather hard to follow. Ray Dalio comes out. And Ray Dalio from Bridgewater says he thinks the market's got potential to go up. He's a genius when it comes to the markets. And then you got the J.P. Morgan trader coming out that predicted the most recent flash crash, telling people that he thinks that there's potential for a cataclysmic decline in the S&P. I don't think this is over. Now, Hussman, he's made some great calls. And what I've done is I put this link in here because what I'm going to do is I'm going to, like what the guys said, we're going to be able to keep these slides up and let people look at them. I would grab this story. It says exactly at the bottom. It's an unusually depressing note that the stock market could crash 50%. I don't think that that's going to happen. I put out something in the beginning of the year that I thought that there was a downside objective in the S&P of 1580. 1580 is my level on the downside. And again, as the markets go up right now, we're looking at the futures rally. I still think that there's still a lot of problems over the top of the markets right here. I don't know if the S&P will top out at 1960, 20 even. That said, there's been a lot of downside and there's been a lot of negative overtones here. So, again, what I'm going to be doing is I'm going to be flipping through these slides kind of so that we can take questions and talk a little bit. Now, the stock market exodus, I follow MOC orders. We've got a product that is called the MIM. And the MIM basically is a data feed from the New York Stock Exchange that shows MOCs that go into the the 245 in balance and the MOCs on the New York Stock Exchange. Doing all that program trading I did for all those years, I was required to keep track of fair value, and I was required to keep track of inflows and outflows. And I remember during the credit crisis, all the big outflows that came out during the credit crisis, and I believe that these outflows that we're looking at, the 53 billion in outflows, is some of the biggest outflows I've seen in many years. But I want to point something out. Starting in March of 2015, the mutual funds started to reverse some of their buying. We would see this on the close every day in the S&P at 245. We'd get the cash and balance. Right up throughout the 6-7 year bull market, there was an unusually high number of buy imbalances that would come in on the close. At the end of March on 2015, those buyers, right in front of all this stuff about the Fed raising rates, started to turn sellers. If you go back and you look at what happened earlier in March, like what I was talking about, the seasonalities that come around in the best 6 months, and what the Pitbull was talking about, a high in July of 2015, and to be worried about an increase in volatility, he was right on with that. But nobody would have understood that the S&P the Dow Jones could open 1,100 points lower in the futures, or that the S&P could be lock limit down. No one could have known that was going to happen. But what it did is it set off all sorts of bad memories of things in the past, and especially, I think that, and as we move the slides forward, that we haven't seen the last of the flash crashes. I don't think we have. I know that there's circuit breakers on the floor to prevent all this kind of stuff, or there's circuit breakers around, but at the end of the day, when you have lopsided selling like you've seen, that you saw in the flash crash, and there's been many other ones, they just don't list it. And what you saw on August 24th is a great example of not being able to, the markets not being able to hold, and watching what the programmers say is that they supply liquidity. They backed away from that. On August 24th, everybody backed away from making the bids on the open. There were gigantic losses that were occurred on the open. If you were lucky and you had a margin call, and the firm that you were trading through didn't liquidate you, and agreed to let you hold those positions, and you made it through that, you were fine. But if you were one of those unlucky people that had to go in on August 24th when the VIX was like that and not quoting for 15 minutes, and you had to go into the S&P options and make a market for that, you got killed. And you can imagine that there were a lot of people that got killed. But anyways, what I want to explain is, while we've seen these enormous outflows, there's been a flip-flop of buying going on in the S&P. Now, at the end of January of 2016, these mutual funds started turning buyers. They bought on the final trading day of January, of this January. There was a big buy imbalance. There was a supposed rebalance supposed to be. Credit Suisse had come out earlier in the week and said that there was going to be $11 billion rebalance. On the close on that Friday, on the last final trading day of January, a $4.4 billion buy imbalance popped up, and from that point on, there have been buy imbalances every day, with the exception of 2 days since that time, 2 trading days since then. So while these statistics show that there's been a vast amount of selling going on, big time outflows, what we've been seeing is that there's actually money starting to go back into stocks. Now, I don't know if that's part of the reason why the S&P is rallying right now. I could say that one thing that we know for sure, that there's a decouple of the China weakness against the S&P. Maybe it's just, again, at the end of the day, I'll always say this. I think that the main stock index of the world, the number one stock index of the world, is the SP 500. It always starts here first, and that's always going to be that way. It's always been that way, and like I said, we see this kind of stuff happen after big declines. Once money starts flowing back in like that, you start to see the market start to sharp cover and start to go up. I know that crude oil has played a big role in this over the last couple of days, but in the long run, I still think that the S&P will outperform on the upside once both markets start to level off, if they actually start going higher. So I'm going to move this forward real quick. This is just an article from the Wall Street Journal. It's kind of showing the performance of this year. It's nothing really. You know, it's kind of like what I was saying in the last week of January. You got a big pop, and then you get a big smackdown in the beginning of February, and now we're going back up. I'm not 100% sure the way this price action is set up is that the markets are all close to clear, that you can just say, hey, you know what, I don't think we've got to worry about all this volatility that we've been seeing that started in August and has basically been nonstop until current. Over the last couple of days, the VIX has come down, the futures have rallied. But again, I think what's going on here is that maybe some of the concerns that have been overshadowing the markets for the last couple weeks, couple months, seem to be dissipating, but they're not going away. Again, Shanghai Composite down 6.44%. At some point, if the Shanghai Composite continues to go down, the U.S. markets will play catch-up with that on the downside. So right now we're on the upside, and I want to point out that we're seeing a lot of MOC buying that's been going on since the end of January, and I think this has got an effect on it. Now, one of the ongoing problems right now with destruction of the stock market, and I think at the end of the day, all the futures exchanges too, what they've done is what I always say, you can't fire your largest customer. Whether we like program trading or whether we don't like program trading, it started on the New York Stock Exchange. Once it got too loaded up, it went out to all these other stock exchanges. Once so many people, so many algorithmic trading firms, much HFT programs hit that, what happened was that there just wasn't enough money to be made in the markets where they were making a penny or a penny and a half years ago, or 5, 10, 15 years ago. The spreads between these markets now are minuscule. They make peanuts to what they used to make. Now what's happened is in order for the exchanges to maintain their presence, I believe on the trading floor, they have to up these fees. And we're upping these fees at a time when there's gigantic concern about the integrity of the markets. I think that with what's gone on over the last several months is people are looking at this and saying, Jesus, what if something really major happened while the markets were going down like this? What would happen? How far could the markets go down? And at the end of the day, again, I know that there's circuit breakers and there's rules on the New York Stock Exchange. I think it's Rule 48. But at the end of the day, Rule 48 allows the staggering of the opening of stocks on limit down, on big volatile days. And you can't open one stock that could be tied to a basket of other stocks and open that stock and then come back and say they've got the right as a floor broker to cancel that trade. So at the end of the day, the rules are just not working for this highly volatile stuff that goes on in the marketplace. It concerns me enormously. I've been there, you guys. I mean, we've watched the markets go up and down for years. We've been all over the world. We dealt with every large type of customer that you can think of. And at the end of the day, what's happened with this is the big hedge funds that we used to do business for, or the big investment firms in the Middle East like ADIA, world's largest investment firm, they would trade thousands and thousands and thousands of S&Ps every day, thousands of bonds, thousands of currencies. They don't do any of that anymore. And they don't do any of that anymore because it doesn't make money. They get chopped up like everybody else, and they have no edge in the marketplace. So, at the end of the day, guys, I always say this, that it's not going to be easy. It can be done. You can make money doing this. I've got a little methodology where I try to buy falling knives and sell the rips, but then I use tight stops. I get out, and if I get stopped out and I still think the trade's good, I get right back in. So, but what I do know is that there's this high. I'll just say it. Did anybody notice how crude oil has acted the last couple of days? If there wasn't an increase of algorithmic activity in crude oil over the last couple of days, that has been a main driver of what's been going on. I mean, when I look at these charts and I see the volume ticking on crude oil, I'm like, wow, who's behind all that? That's not human. These are programs that are designed to run the buy stops and run the sell stops, and I'm gonna move this forward because I know that there's a lot of investors out there, small guys, that lose money. Now, in the broader sense of what's going on here, Sure, the S&P can rally, but we're in a global shrink down. And I know about this stuff because we used to do all the Bank of America stuff. It was the largest prop trading desk in the world. The guy that ran the desk garage after the credit crisis started, he had, I don't know how many $100 million, like $600 million his book was up. He had been at Bank of America. He ran that book for 4 or 5 years. And then the credit crisis comes along, and they force him to fold up his book into Merrill Lynch's book at this $3 billion in debt. He left the firm, opened up a new clearing firm, and then left that clearing firm and became a stand-up comic on Wall Street. His name's Raj Mahal. You can look him up on CNBC. He'll be at my house next week, and we're going to have him live. But anyways, what's happened here is it's not just a shrink down, a global shrink down. You know, China and their deflated numbers and all the stuff that we've always worried about, the things that we've heard about are coming to fruition. They're toying with they're messing with their currency to keep the United States products, they're just the way they mess with the dollar, they keep us kind of pushed out of being competitive, and I think that's because I think they're in trouble. I really do. I think in the long run here, China has a lot more to go on the downside. I think there's a lot more surprises to come out of China. They're not going to play fair game in their currency markets. But when I look at this stuff, what's going on at J.P. Morgan, this is exactly what's been going on since the beginning of the credit crisis. There was a big party on Wall Street. All these big banks, all these big hedge funds, all these big brokers made billions. And then when all this stuff collapsed, the main driver of all this was trading profits. All the big firms, and J.P. Morgan is one of the biggest trading firms in the world. While they're a bank, they took on more risks than anyone I just remember on the trading floor. Every desk that they had was doing big trades, and as a guy that was trying to get business, I would go to J.P. Morgan. My buddy used to run the futures department, and we could get some of that business, but I'll tell you what, it was gigantic. J.P. Morgan traded huge all over the place. If it wasn't in commodities, remember they had a huge commodity desk that they shut down. And yeah, trade, don't invest. I agree. But they had the big commodity desk that they had to shut down with gigantic losses years ago. Remember that? And then now we're moving forward with all this regulation. And as all this regulation bears down on these banks, they're forced to shut down these trading operations. And the ones that they have, like this, is losing $500 million. It's losing huge money. Now, and like it says, in order to maintain the positions, they got to put up another $1.5 billion. They will. I'm sure that they will. But at the end of the day, I don't think that this is the last time you're going to hear about losses at J.P. Morgan or some of these big major banks out there. They're still holding on to some of these things that are responsible for what caused the credit crisis in 2007, and I still think that what was a couple of weeks ago. What happened to Deutsche Bank? Did Deutsche Bank get all better? I know China hasn't gotten all better, but did Deutsche Bank all of a sudden just fall off the radar? And then all of a sudden you got J.P. Morgan. There's a trend showing here, everybody. And it's called the Great American Shrinkdown or the Great Global Shrinkdown. And I don't think this is going to change. There's no way. That doesn't mean that the markets can't go up. Well, anyways, look, this is the LULUD rules. And these rules were set up by the New York Stock Exchange in the flash crash for halting securities and stocks on the down. They say both sides, both up and down. But at the end of the day, how often do you hear about problems with a limit-up product? I mean, unless there's a short squeeze in the futures or something, or in cotton or something. Hey, cotton's limit up. You just don't hear that crap, and that shouldn't be a concern. But what happened on August 24th was a great example of the systems not being able to hold the volumes. And I remember this distinctly, you guys. There was a very, very big trader that we know that was forced out of liquidating a position on this Monday morning. And the spread between the bid offer on the spread was $18 million. $18 million. And you know why that is? Because they couldn't get the VIC going. And I'm going to tell you something behind all this stuff. If there's ever a gigantic meltdown and all this stuff goes at once, it's not going to be like any other decline that we've ever seen. Forget 1967. Forget 1970. Forget the 85 crash. Forget the mini crash. Forget the 1999-2000 tech bubble. Forget the Gulf War I and II. Forget all that. There's never going to be anything like what's going to happen in the future if they can't figure out how to nail down this stuff. Rule 48. Basically what the rule says is that if a market maker or an order filler can open up the stock and they can't get the rest of the basket open, they can come back to you and cancel the trade. So if you were so lucky on that day, on August 24th, to actually buy a stock that you tried to buy and they filled you, they can come back and tell you the trade's canceled. So I don't know how that rule is going to work for people. But in the end, you know what the thing is? This is all set up against the big institutions. What they do is they fold up shop. The big algorithmic trading firms, the big HFT trading firms. They just, remember, they're the guys that supply liquidity. If you do 2 million minis in a day, let's say that you do 1.3 million S&P minis in a day. And the total volume, 300,000 of that volume is from Globex pre-open. 1 million minis trade during the day. Excuse me. 1 million minis traded in a day, but that doesn't mean that that's customer volume. I think 70% of that is algorithmic and program trading volume. And on big days, I think it's 80%. So what do you think is going to happen when 80% of the volume disappears someday when the markets start going down hard? I'm going to explain something. I'm a bull. I've always been a bull market guy. I love buying weakness. It's my mindset. I love buying the falling knives. But I'm going to tell you something. When all this stuff started unraveling at the end of July, and I was listening to the pit bull, and I was watching all the increased volatility, I knew about the best in the 6 months, the worst and the best in 6 months for stocks. And as we went into that spooky October, and this stuff was set up to really do some big damage. But we really didn't get the damage going until the beginning of the year, toward the end of the year. Now, they say as it goes, how January goes the year, and I believe that. I know that we're on an uptick, but I still think that there's a lot of moving parts out here. And I guess the main thing I'm going to say, I'm concerned, and I think everybody should be. I don't know what, and I'll tell you what. Over the 7-year bull market, I remained a staunch bull on every pullback that occurred over the last 7 years. I was right there saying buy it. It didn't matter if it was down 50. It didn't matter if the S&P was down 80. It didn't matter if the S&P was down 200 handles over a 2-week period. I was there saying buy it. I'm not saying here. Very seldom do you see me buy it, but I will show something where I did say buy it in a minute. But I think that there's it's a very uneven playing field out here for the small investor. And I think there's a lot of landmines that people don't understand. And this kind of stuff is really crazy. Okay. Why it matters. Well, at the end of the day, August 24th was very much like a guy that had been in Vietnam, a soldier that had been in Vietnam. And he came out, and he still had these battle wounds. Well, I was still a soldier from the 2010 flash crash. I was still having flashbacks. And when this happened on August 24th, everything that I had thought in my head went green lights. I knew exactly what was going on. And I'm going to show you that I knew exactly what was going on as we move this forward. But I'm going to tell you, one of the big things that I think that traders tend to get away from, if you're a futures trader, you tend to get in, you tend to get out, you move on to the next trade, and that's the way you're supposed to do it. But behind all this are things like ETFs And what I think happened on August 24th was you had this enormous amount of selling and no bids. And like it says in the lower part of this, the transparency is a big part of it. But on days like that, there's no transparency at all. You're a victim of whatever maybe might happen good. But nothing usually happens good on this kind of stuff. But at the end, what happened was these stop-loss orders in the S&P really did have a big effect on this. Now, on August 24th, I'm going to explain something that happened. The MIM, the MrTopStep MIM, that day, pre-open, was showing $6 billion for sale. What happened was when the futures opened lower and that next leg down, that was all that cash selling that was going into the S&P after the initial open. It opened higher and it opened down sharply, and then you had that big slam down. Well, we got to see that. Not very many people got to see that. And again, I think that being able to see some of this and following some of the money, it's institutional money. It's Goldman Sachs. It's J.P. Morgan. It's all those big institutions that put in the orders like that. And the other side of this, and their ability to pull those orders or cancel and go the other way. So, I think what's going on here is I think that there's been a refocus here of watching the markets go up, but not paying attention to a lot of the problems that were here over the last 3 or 4 weeks or even 2 months. Now, I told you I'd put up a couple S&P charts. I trade the S&P for a living. This is a Market Delta chart. Trevor, the owner of Market Delta, long story short, after CME bought the Board of Trade, and they moved the trading floor over to the Board of Trade, we had to get an office over at the Board of Trade. And when we got an office, we were brought into the building by a real estate person, and we went up to the 26th floor. Beautiful little office looking straight down LaSalle Street. And when I opened up the door, there was this office filled with lots of equipment, beautiful furniture, nice furniture, trading equipment, all this stuff, and 1 or 2 guys. And the guy came up to me and he was like, hey Danny, I want to introduce myself. I'm Trevor from Market Delta. Well, at the time, I'd be no disrespect to Trevor, but the desk was still doing rockin' huge business. I'm, a big floor guy. Who gives a shit about any of this kind of stuff? I didn't even give it 2 thoughts. After he moved out, he moved his company back out to, I think out to St. Charles, Illinois, and I didn't hear from him for a long time. And then what happened was, as the floor started to kind of change and the desk kind of started to change, and I decided to go off floor, I needed a tool that I could read. And what I've found for me, one of the better tools, because I'm not that educated with trend lines and moving averages. I have moving average on my current charts, but they're live, so I can see those and I know how they cross over and all that. But I need visuals. At the end of the day, what a lot of traders are lacking when it comes to this, and this is real bullets. This isn't bullshit stuff. I'm not out there trying to tell people I'm going to give them money to trade my account or any of that stuff, or I'm going to take you from a little trader and I'm going to fund you and I'm going to, look at the end of the day, if you want to be a trader and you don't have the money, wait until you get the money. Don't put yourself out into situations where you're spending all this time. You think you're working with some firm, they're going to give you money, and you end up with some small account that you never even get to see the statement on. That's not the way to go, you guys. But anyways, when I left the trading floor, I was determined. I had these trading rules that I made up for years. They're called the MrTopStep Trading Rules 101. And they were an accumulation of things that I had written down on the trading floor and combined with some of the things that Marty Schwartz, the Pitbull, had taught me. Like my trading rule about 4 or 5 sell programs, that the bids would pile up and they would short cover. Or that, the S&P would tend to go from buy stops to sell stops, or, just all sorts of little things that I would use during the day to watch the price action of the S&P. And man, we did so much business that I mean, I can't explain to you the amount of orders that when the markets were busy, we'd have 6, 8, 10, 11 clerks. At one point, we had 11 people at our trading desk. 11 people, including Brian Shepard and I. That thing cranked. Those orders were stacked up. There'd be 50, 60, 80 orders. We'd be trying to get the cards out of the pit. And I'll tell you what, back then, I could trade the S&P. I would go up to a separate desk. I could look up into the S&P pit. I could see where the selling was coming in. I'd sell, and I'd make my $2-3 grand. I'd get out. I'd go back to the desk. I'd go back, make a couple more grand. And it was a lot easier. I'll tell you what. There was a lot of inefficiencies in the marketplace back then, and that's why a lot of traders got to make a lot of money. And that's why a lot of traders from there that walked out of there never even really tried to make any money on an electronic platform because they weren't really trading in the first place. They were scalping, or they were front running, or they were doing whatever they were doing. But once that component got taken away, and an algorithmic trading that tightened up what I call the bid offer, or the VIG, VIG, the spread between the S&P, or the spread between the bid offer of corn, or the spread between the price of a bid or offer of silver. It's the VIG. Once the VIG got pulled out of there by electronic trading, it basically got pulled out of there as soon as electronic trading started in 1996. But as more and more programs were allowed to connect to the front end of the CME's servers and dial directly in, it changed everything. We talked about the guy from London and Sang being the guy that caused the flash crash. Bullshit. I know what caused the flash crash. No, nobody can tell me what caused the flash crash. I was there. I lived it. I saw it. I touched it. I felt it. It affected my life forever. And that guy did not cause the flash crash. I mean, I don't know where they get this, but that's crazy. But anyways, look, one of the things that I think is important about when you're trading is developing patterns, things that you see, things that make sense to you. Over time, you develop these patterns, and you don't necessarily. If you're looking for them and you're constantly looking for them, you can write them down. You'll see them. One of the things that I've learned is, and this is one of my trading rules, is that I really believe in the S&P. No stops go untouched. They just don't. One way or the other, somehow, some way, they're going to get those stops. They're going to get them up. They're going to get them down. They may even get them up and down again in one day. And that's the way this all works. So here I go in. I'm in the forum. I tell everybody I paid 15 even on the S&P. I'm big, small, whatever. I keep my trade small because I don't want to lose tons of money. If I can make $2-3 grand a day, I'm happy. If I can make 1,500, I'm happy. If I could make 10, I'd be really happy. But 10, if you're making 10 or 20 grand a day, you're risking a lot more than a guy that's trading out to make a grand or two. It's not. So I use a tight stop. The futures go flying up to 19 even. I sold half at 19 even. What do? What does the S&P do? It's got to go back down. It always has to do that retest, and these retests are real. If you can follow market delta imbalance charts or footprint charts, you'll be able to see how these bids come piling in at a low. And after they go bouncing up, there's generally a retest that occurs after that low happens. And here's where I be honest about this. This is a weakness in my trading strategy. I do what everybody does. Once I get a profit on the SPOO, I take half off. And then what do? I go and I put in the break-even stop. And then what happens? The S&P always goes down and runs the stop. And again, my stop was under. You see where the stop says? I was risking like $2 or $3. So if I had not moved my stop, if I had dropped there, and not followed that stupid rule that I think is, I'm not going to tell people not to trail stops. I'm not that person. But the Pitbull's taught me something that's, you're either in or you're out. He calls it, there's no being half pregnant. You want to trail the stop. Maybe what you should do is you shouldn't have scaled the half, and maybe you should just honored your stop and let the market go up. It's $1 million question. But all I know is that it happens to me, and I can't be the only person out there. There's no way. So at the end of the day, you guys, look, trading's never going to be easy. It's going to be through perseverance. It's going to be through trial and error. It's going to be through looking at this kind of stuff. It's going to be knowing that early in the day that the market can make a low, and you can say to yourself, hey, I think the low's in. But that doesn't mean that the S&P can't rally and reverse and go back up again. There's just two program trading. It wasn't like this in the 80s, and I know that it's a throwback, but the Pitbull in 1990, after the 87 crash, he came to me one day on the telephone. He said, you know what? I'm going to take out $1 million ad in the Wall Street Journal condemning program trading. Well, in the 87 crash, I was doing all that program trading business, and I took a 3,000 lot big S&P order, $1 million handle. And this account came to me, and they had to sell these things at 10 in the morning, when 10:30, when the markets are crashing. I don't care what anybody says. I've been part of every major market event that's been going on here. I start selling that 3,000. The only bids in the place were UBS program trading for sell programs and Morgan Stanley over my shoulder. They knew I had the big size to sell. I just leaned back. I'd yell into the phone to the UBS guy. I'd go, size! And he knew exactly what I was doing. He'd say, Danny, pay 68 on 200. Pay 63 on 200. Pay 61 on 200. And I'd see the guys at Morgan Stanley behind me laying in their bids. And I'd just lean back and I'd look in the bid and I'd go, sell 1,000 down to 60 even. And just clear the whole book out. And then watch the Dow drop 60, 80, 100. So I know what this stuff does. I mean, come on. At the end of the day, how many people do you know that took that kind of hit? There's just no one out there like that. And then when the CFTC wanted to talk about this, and the CME said our desk didn't do anything wrong. The CFTC said our desk didn't do anything wrong. But do you think they wanted to ask me about what I thought happened that day? I was told to shut up, and that's the honest-to-God truth. So, this is a good one. I'm going to say this again. I don't pretend to be smarter than you. But at the end of the day, I'm going to reiterate something that you can use your machines, you can use your charts, you can have all the fancy gizmos, and you can have all the different types of indicators. You can do all this stuff that you want to layer and layer and layer on things that make your trading more. Keep it simple, stupid. I read charts. I read volume. I don't sit around trying to draw lines on charts, because you know what? The lines are already drawn. Every day after the market moves, I could move my cursor down after a high, and I could say, well, people would say, well, where do you think the S&P is going to pull back to, Danny? I'd say, well, we're trading 24 right now. Initial pullback, you can see I'd pull my cursor over, look at the market delta charts. I think initially they can go to 18 even. What do? They go right to 18 even. Then they say, well, where do you think they're going next, Danny? I think they can go to 12, 11, 13. They go down, they make a low at 12 and a half. I mean, I've been doing this for a long time, you guys. And then, you know what? At the end of the day, I've done this for institutions, banks, prop trading firms, individual investors, everybody my whole life. That's what I do. I defended the customers that went through my desk on the trading floor. As I said, it didn't matter to me if it was a 1 lot or a 500 lot. Someone was stealing money off that order. Hey, it's 10 bid at 20, 10 bid at 20, 10 bid at 20. Hey, buy one. Hey, you paid 60 on one. No, I didn't pay fucking 60 on. Oh, excuse me. Excuse my French. I didn't pay 60 on one. 30's a high, and the 30 trade wasn't even on the board. Hey, you paid 60 on one. Come on. I'm getting fights over 1 lots. It seems silly. But anyways, in this particular day, this is where the S&P made its retest. It got down. Everybody was bearish. Got down to the old lows at 1805, and everybody was bearish, and it looked like the world was going to come to an end. And what did I do? I went out in my room. I went out exact times. You go back and you pull these times. You do a time in sales August 24th, and you find out exactly what I do for customers every day of my life. I I went out on Twitter. I went out on my forum. I said, where do you think the next 50 handles are? And 85% of the people on Twitter, I'm not going to say in my forum because they knew what I was talking about, but 85% of the people on Twitter said that they're going to crash. I said the next 50 handles was up. Over the next 3 hours, the S&P rallied 65 handles. So look, at the end of the day, look, I'm going to say something. The S&P never does what everyone wants it to do when they want it to do, when they want it to happen. It's never going to work like that, guys and girls. You want to trade the S&P, you want to trade the yen, you want to trade gold. It's all the same stuff. It's never going to do, these contracts are never going to do exactly what you want it to do when you want it to do it. And once you figure that out, you'll open up a whole different side to knowing how to trade. And it's not going to show up on your charts. You got to learn to develop a feel for the markets, a feel for what you're looking at. You have to use your gut instincts, and you have to reach down inside. When it comes time to make the hard call and step in front of the freight train, you got to have guts. And once you can apply those guts and a market feel together with your charts, you're going to become a much more successful trader. I guarantee you will. The markets talk to you. They talk, but you got to understand the language. And it's not that hard to understand this language as long as you're willing to keep your mind open and follow volume and watch how these programs operate. I've been doing it for years, you guys. Yeah, look at another little rule that we've got. This goes back to the market selling off. I'm gonna implore everyone that trades the S&P to pay careful attention to retest. Retest our entry levels. If you can pick these retest stuff correctly, you can make 10, 15 handles on trades very, very easily. The S&P always tends to retrace the low. The S&P comes down, it's going on 10 o'clock, the S&P sells off, it comes back down, it looks horrible, it trades down through that price by maybe, I'm not in this particular situation, but I'm just kind of pointing it out, that it may violate that old low by a handle, it may violate it by a couple handles, but those retests are the most effective way to look at a market, and I'm telling you that on my moneymaker chart that I've got, I will look at those retests all day long. I depend on the VWAP. Once I see the buying coming in after a sell-off, I see the volume start to pick up. I see the buys start to come in. I see the S&P start to buy, get above the VWAP and more buying coming in. Then I know that I got it. But I'm always looking for those retests. And the reason that I have my methodology is that when I get in, I tend to be a little early to the party. I may get in a little early. And generally, if I use like a $3 stop, I'm generally getting stopped out at the price I should be getting in. I think that may be what this chart is probably supposed to be. But at the end of the day, what I'll do is I got this feeling, right? I think I think we're getting close to the low. I bought them a little early. I get stopped out. Sometimes I won't even honor that stop. If I think they look like they're going to make leg down again, I'm risking $3. I may get out at a handle loss if I'm lucky, or I may get out at a $1.50 loss. But what I try to do is I know that I've got a stop in there that in case something happens, I've got my stop in there. But I'm going to go to the market if I think that the S&P, if they're going to knock me out, I'm going to get out first. It's like a street fight. If you know someone's coming to get you, go get them first. Don't wait for them to knock on your door. Go get them. Don't sit there and wait. And then what I do is if I'm wrong, then I get right back in again. And I'll do this a couple times. And if I'm wrong 2 or 3 times, then I'll stop. And then I'll reassess my levels, and maybe I'm wrong. But I'll tell you what, I think if anybody from our forum is in here, they would tell you that I call highs and lows all the time, that I participate in those highs and lows. But I'll be honest, I have a hard time holding. If I could catch a flyer, like yesterday, I caught a flyer. I'll show you. Let's see. No, these are just the net changes. Let's see. I mean, you know, look, at the end of the day, this is just a good chart to kind of show you how crazy things are or have been, you know, and we could talk about this, but, yeah, again, I think that this chart speaks for itself. It's going to, this stuff may go high, the S&P may go higher, but, you know, I think it's more like waiting for the other shoe to drop. And again, I'm a bullish guy. I think eventually the S&P will recover, but let's see. Okay, so here we go. This is a particular day where everybody was talking about the S&P going up. And I was adamant, and I stayed adamant, that you had to be short the S&P. You had to be short here. I gave all the reasons in the world to be short 35, 36. Now, I'm not going to say I had the high. I'm not going to say I had 37. But I was shorting. I had an average price of 35.5. And I told people, and I told people, and I told people that not to be long, to beware of that the S&P was going to correct, and it did. And we corrected, and we corrected, and then at the bottom, I came out and I said, I think the next handles are going to be a 10-handle pop, and we all know what happened. The S&P skyrocketed. So, again, another example, and again, this is all real stuff. I put it out on Twitter Live. I got to delay it a little bit on Twitter because the forum gets upset with me. But at the end of the day, what we do is we work as a collective. I don't take credit for anything more than the little things that I do. I think that there are things that people can learn if you're willing to kind of keep your eyes, if you're willing to keep your mind open and keep your eyes moving. I think that this is stuff that I could probably teach you. But again, I don't know that it's something that it can be taught. You've got to want to learn it. You've got to want it. You got to want to own it. And I'll be honest with you guys. I mean, I did a lot of screwing around when I was on the floor. I could have taken advantage of a lot of trading, and I didn't. And then as the business dried up, I had no choice. It was either go get a job or try to get a job, which I would have been like a lot of other traders out there. I didn't go to college, so where am I going to go? So I decided I made MrTopStep, and I wanted to share things that I knew about from the trading floor, things that I lived, things that I saw, things that I could point out, and that's what it is. We're a collective of traders that likes to work together, and that's it. Now I'm going to finish this off just by saying one thing. The markets are bullish, and we're going into the end of the month. And the good rally today. I said yesterday on the close that I thought that the S&P could rally today. I said that it would rally overnight. I came in this morning. I said that if the S&P pulled back, that it would get down toward the Globex lows. It would bounce. Everything that I've said has been correct. Now, I think the S&P does have potential to go higher, but I'm going to warn everybody about Friday. What my own feeling is that the S&P can go higher, at least for the first half of the day. And I also say that there's three parts to a trading day. There's the Globex session at night, there's the 8:30 bell, the 8:30 open, and then there's whatever the mutual funds have to do after 2 o'clock in the afternoon, and you should never forget that. They always show you different aspects of where the markets are trading, particularly after the 8:30 open. They could show you the market could be weak all day, but behind there is a bid to the market. And that bid's going to show back up in an imbalance or an MOC order late in the day. So that's why when you see this stuff, I always say you get part one and part two of after the 8:30 open. You get whatever happens after the 8:30 open, and then you get whatever the mutual funds have in store for the late afternoon. If they've got buy orders, 90% of the time, the futures rally. That's what you see in the afternoon. That's what you've been seeing in the afternoon ever since the end of January. Now, I just want to talk real quick about this. This is my friend Jeff Hirsch from the Stock Traders Almanac. He's going to be at my house in a week or so. The markets tend to firm up at the end of the month. And and then the mutual funds tend to buy stock, and it's called T+3. They say there's no T+3 anymore, but I'm sure that the mutual funds still mark up and mark down stock. Whether they have 2 or 3 days to hold that stock before they post it, I don't know, but I'm sure there's ways that they do it. So the final 3 days of a month are always important because the mutual funds tend to buy on those final 3 days. But what happens on the final day of the month is that sometimes those mutual funds run out of money, and we call that the walkaway trade. And those walkaway trades are particularly interesting at the end of a quarter, where the big mutual funds may rebalance to the sell side, and they buy stuff, but then by 11 o'clock Central Time or 12 o'clock Central Time, the mutual funds have used up all their buying power, and they leave the S&P susceptible to a sell-off. This is one of MrTopStep's rules. We follow it all the time. So that said, what happens is they tend to buy stock at the end of the month, and then they tend to buy stock going into the beginning of the month. But I'm going to forewarn people that while the S&P may be good, and there may be more upside here, and I'm sure there is. I don't doubt that there is. And I'm not bearish. I'm not bullish. I'm just skeptical. I want to point out that I think that there is opportunity for the Dow Jones and the S&P to rally in the beginning of March, but I would be forewarned traders that you don't want to necessarily be long going into the end of the month. I would say that you have to be very, very careful. I would say that if you've got profits from longs early in the month and you're going into the middle of the month or into the third week or in the middle of the month, I would lighten up those positions, and I would look to re-enter those positions at lower prices. I don't think this is over. But anyways, you guys, my last and final slide is I want to thank everybody. I want to thank Big Mike for letting me come in. I think that, look, at the end of the day, I think you have to decide who's real in this game and who's not. And I think when you associate with those traders that are real, you find real value there. I think Big Mike in his new forum creates a ton of value. He's an honest guy. He works hard. He's very similar to what I think I aspire to be. And you know what? At the end of the day, it's all about connecting, and I believe in one thing. I'm going to close it out by saying one last thing. That this is a game that you can win at, but you're going to have to persevere. You're going to have to earn it. You're going to have to work hard. And I don't think that things just come easy like they did in the old days. You know, when we go on Periscope today and we're looking at that trader movie that Nigerian did. What's it called? These guys they made lots of money in the pit. And they get to show all their expensive guns and all these animals they killed and, big all this stuff. But you know what, at the end of the day, you guys, it's not that they couldn't make it. It's that they couldn't keep it. And the art of trading isn't just about making it, my friends. It's about keeping it. So listen, I don't want to continue to haul this out. I wanted to do a 45-minute thing. I want to thank everybody for me coming in. If you guys have any questions that you want to ask me, feel free. I get a lot of emails from people. I'm not a trading coach. I'm just someone I always say this. I've seen the top of the mountain. I've seen the bottom of the mountain, and I'm somewhere in the middle. And if I can help you guys avoid some of that, I'm more than happy to help. My email is danny@MrTopStep.com. And I want to thank everybody, and, good trading to you. I hope that we put on a good show.
All right, guys. Thank you all for sitting with us and listening to Danny. Thank Danny for this great presentation. I always like to hear Danny talk. Follow him on Twitter, on YouTube. This video will be on YouTube and on the FIO website as well. If you're watching this at a later date, please like, comment, subscribe. Everything you do on social media helps us. So thank you. And I'm going to close out the webinar now. Thank you, guys.